Hello, everyone. This is Luis Concepcion with Strategic Profit Line Trading. Today, I'll be going over how to purchase a cash secured put, what a cash secured put is, and how to execute. Today, I am working on the TD Ameritrade platform. I am on the chart of the S&P 500, also known as the SPY, and I'm on a daily chart. So, a cash secured put allows an investor to purchase a stock at a price below its current market value. It's a very effective way and strategy for purchasing assets at a discount. So currently, the last price traded on the S&P 500 was $412.35. I put a predetermined line here at 400. So as investors, you should always be thinking on how to get things at a discount. So I'm going to determine that $412.35 is just too expensive for this asset known as the S&P 500. So how can I get paid to wait? And in order to do that, we would call what's called a cash secured put. So what we can do is sell a put at $400 and get paid while we wait for a predetermined time to own the S&P 500 at $400. So if we go over to trade, let's say we're going to go out to the 17th February, which is 12 days away. And I'm going to stay on the right hand side of the screen because that's where puts are. Remember, we want to sell a cash secured put. And we've already selected that we want to own the S&P 500 at 400. So if I click sell, you can see that once I click it, I have this dialog box, single sell. I'm going to change this because it defaults to 10 to 1. The SPY, 17 February, buying a put, and my account is going to be credited $186 or $1.86. Remember that every time we're dealing with options, everything is a multiple of 100 because every single option contract represents 100 shares of that underlying asset. So what does this mean? Going back to the chart, if I sell a $400 put, I'm going to get paid $186 between now, immediately. However, if price is at $400 or below on the day my contract expires, I will be obligated to purchase the S&P 500 at $400 and I will be paid $186 immediately. So what does this mean? If between now and the next 12 days before my contract expires, price is at or below 400, I will purchase the S&P 500, 100 shares. I will be obligated to buy at 400 and I will keep my credit. However, if between now and the date of expiration, price stays above 400, I keep my premium and I'm not obligated to purchase the shares because it never reached 400. Hence, I can do this on a bi-weekly basis, monthly basis, generating cash flow until I am assigned the shares at whatever strike price I select. Now, what I need you to understand is that in order to execute this trade, you must have the capital required to purchase the asset at the strike price you selected. So if we select the 400 strike, you must have $40,000 in your account in order to execute that trade. Because if by the time your contract expires, its price is at 400, you are obligated to buy those shares at $400. So in order to execute the trade, once again, whatever the strike you select on that cash secured put, you must have the appropriate amount of capital in your account, meaning you take your strike price and multiply it by 100, and that's the capital required in order to execute the trade, hence a cash secured put. Once again, this is a very effective strategy for purchasing assets at a discount. You must have the capital in your account, and your total cost at assignment will be the strike price minus the premium. Let's show you another example. I'm going to select Tesla. So Tesla's currently at $189.98. That was the last time it closed. Let's say I want to own Tesla at $140. So you would simply come over to trade, and you can see the 17th February is already open, and we said $140. So I can come over to $140, and you can see that currently it's paying 39 cents or $39. What if we went out a month to own Tesla at $140? I'm going to select 33 days, go down to 140, and you can see now we're getting a better premium of $188 or 197. And in this case, at $140, which is right here, in the event you select 140, you would have to have $14,000 in your account, and you would get paid while you wait to own Tesla at $140 because you deem at this price point at 189.98 is too expensive. So you would go ahead and sell the $140 put. You would get paid that premium or credit as long as price does not get down to 140 between the time you selected your expiration. You keep your premium, and you can do this on a bi-weekly, weekly, monthly basis in order to generate income and or purchase stock at a significant lower price point. And that is what a cash secured put is. Let's go back to the SPY, our previous example, understanding that you can utilize this strategy multiple times to generate income and or purchase things at a discount. I hope that this information was informative. You understand how cash secure puts work. Till next time, happy trading.